The 5 money mistakes killing Australian middle-class wealth. There are Australians earning $120,000 a year who will retire broke. Not because they didn't work hard. Not because they didn't earn enough. Because they kept making the same 5 money mistakes year after year without ever realizing it. And the brutal truth is, these are not the mistakes of people who are careless with money. These are the mistakes of people who think they are doing everything right. Middle-class Australia is in trouble. Not the kind of trouble that shows up in your bank account today. The kind that shows up at 62, when you realize your super won't last, your home equity is locked away, and you've got 20 years of retirement staring back at you with no plan to fund it. So today, I'm breaking down the 5 money mistakes that are quietly destroying middle-class wealth in Australia right now, using real numbers, the latest data, and the 2026 budget changes that just made some of these mistakes even more expensive. Let's get into it. Mistake number 1. Treating your home as your entire wealth strategy. Almost 70% of all Australian household wealth is sitting inside the family home. That single statistic explains more about why middle-class Australians feel stuck than anything else. Your home is not a cash flow asset. You cannot eat equity. You cannot pay school fees with your capital gains until you sell or borrow against it. And with the 2026 federal budget now limiting negative gearing on established investment properties purchased after budget night, the rules around property investing just got tighter. If your entire plan is to own a home, pay it off, and sell it one day, you are not building a wealth portfolio. You are building a liquid, undiversified asset. The fix is to treat your home as your foundation, not your finish line, and build income-producing assets alongside it. Mistake number 2. Ignoring super until it's almost too late. The average Australian barely glances at their super until they hit their 50s. By then, a decade of compounding has already been lost. Here's what that actually costs you. A 35-year-old with $80,000 in super who contributes nothing extra will have roughly $380,000 at 65, assuming 7% average annual returns. That same person, adding just $200 a month in salary sacrifice from age 35, ends up with over $560,000. That's $180,000 difference from $200 a month. And with the concessional cap rising to $32,500 from the 1st of July, 2026, there has never been more room to push money into super at a lower tax rate. If you are not salary sacrificing at least something into super right now, you are leaving one of the most powerful tax structures in Australia completely untouched. Mistake number 3. Carrying the wrong debt for too long. Middle-class Australia is drowning in acceptable debt. Not the dramatic kind. The quiet kind. A car loan at 11%. A personal loan from a holiday 3 years ago. A credit card sitting at 19.99% with a balance that never quite reaches zero. These are not small problems. A $15,000 credit card balance at 20% interest, paid off over 5 years with minimum payments, cost you nearly $10,000 in interest alone. That is $10,000 that could have gone into an index fund, into your super, into your offset account. The mistake is not having the debt. The mistake is tolerating it. The avalanche method still works. Highest interest rate first. Every extra dollar thrown at it until it's gone. Then roll that payment onto the next one. This is not exciting. It is just effective. Mistake number 4. Diversifying too late and too locally. The ASX is dominated by banks and miners. Full stop. If your entire share portfolio sits inside Australian equities, you are not diversified. You are concentrated. And you are missing the sectors that have driven the majority of global wealth creation over the last 2 decades. Technology, healthcare, global consumer brands. None of these are well represented on the ASX. A simple 2 ETF portfolio, one tracking the ASX 200 and one tracking a global index, immediately gives you exposure to thousands of companies across dozens of countries. It takes 20 minutes to set up and costs less than 0.2% per year in fees. Yet most middle-class Australians either never start, or they wait until their portfolio is already large before they think about global exposure. By then, they've missed years of compounding in the world's best-performing markets. Mistake number 5. Underestimating the cost of bad structure. This is the one that stings the most, because it's invisible until it isn't. Most middle-class Australians hold their investments in their own name, pay tax at their marginal rate, and never think about whether there's a smarter way to own what they own. Debt recycling, family trusts, splitting income between lower-earning partners, franking credits. These are not strategies reserved for the wealthy. They are strategies the wealthy use to stay wealthy. And with the CGT changes from the May 2026 budget replacing the 50% discount with a 30% cap and cost-based indexation from the 1st of July, 2027, the structure you hold assets in right now will directly determine how much tax you pay when you sell. A good accountant and a licensed financial advisor are not luxuries at this stage. They are the difference between keeping what you build and handing a large chunk of it to the tax office unnecessarily. Here is the thing about all 5 of these mistakes. None of them feel urgent. That is exactly what makes them dangerous. Wealth in Australia is not lost in a crash. It is lost slowly, quietly, in the decisions that felt fine at the time. Work out which of these 5 is costing you the most right now. Pick one. Fix it this month. Then come back for the next one. Because the Australians who build real wealth are not the ones who get everything right at once. They are the ones who stop getting the same thing wrong, year after year. If this hit home, smash the like button and subscribe. Turn on notifications so you don't miss what's coming next. I'll see you there.